welcome you all to our YouTube channel 7 Islands PMS, where we dive deeper into the exciting world of capital markets. In today's video, we are going to talk about averaging in investing. Well, averaging in investing is a strategy where an investor tries to improve his average cost of investments for better returns in the long run. This approach can be applied to various investment vehicles, including stocks, mutual funds, and exchange-traded funds, that is also known as ETFs. There are broadly three types of averaging strategies: cost averaging, value averaging, and cost averaging with dividends. So let's understand cost averaging first. Cost averaging strategy involves investing a fixed amount of money into a particular investment at regular intervals, for example, monthly or quarterly, regardless of the asset's price. Over time, this approach can reduce the impact of short-term volatility and potentially lower the average cost per share. For example, if an investor has Rs 1,50,000 and wants to invest in Infosys, he can stagger his buying in 6 equal installments amounting to Rs 25,000 each. As you can see from the table, investor can buy more shares when the stock prices are low and less shares when the stock prices are high. Eventually, after averaging for 6 months, the cost of 97 shares is Rs 1,546. You can also see the range of Infosys share price was between 1400 to 1700. So the investor can get a better price of his investment. On the other hand, value averaging strategy adjusts the amount invested based on the performance of the investment. Instead of investing a fixed amount, you invest more when the stock price of the investment falls and less when it rises, aiming to keep the investment on a predetermined growth path. For example, if the same investor has 1,50,000 to be invested in Infosys shares, he begins by investing Rs 25,000 in the first month, and assuming that the stock price is at 1,800, he can buy 14 shares. In the next month, if the stock price of Infosys falls to 1,400, the investor invests 50,000 rupees in that month and buys 36 shares. Further, assuming the stock price of Infosys falls further to Rs 1,200, then the investor chooses to invest more, that is 75,000, and buys 62 shares. So the investor has invested Rs 1,50,000 in 3 months, and by value averaging, he could acquire 112 shares at an average price of 1,339 rupees. The third type of averaging is also interesting. It's called cost averaging with dividends. Reinvesting dividends received from investments can also be a good form of averaging. Dividends are reinvested into the same investment, often at different prices, which can average out the cost over time. Example, if you receive Rs 5,000 in dividends from a stock and reinvest the same amount when the stock price is lower than your original purchase price, you effectively lower your average cost per share. So the objective of averaging is to reduce cost by maintaining disciplined investment. Apart from types of averaging, we will also talk about the advantages and disadvantages of averaging with respect to investing in the next video. I hope you find this informative. Kindly like and subscribe for further updates on capital markets. I will see you soon, and thanks for watching.